Hello everybody, welcome to the fourth video of me learning how to trade using Forex. So just as a recap from the last video, I finished writing up the notes from the IG website, and then we've started taking some notes from the official Forex I guess Academy website. So yeah, let's just carry on from where we left off last time, which is, so we finished writing the government data bit, and now we're on the Who Trades Financial Markets section. So, who trades financial markets? There are a range of people and companies that buy and sell financial markets. Institutional investors, pension funds, asset managers, and mutual fund providers participate in financial to make profits from themselves and their customers. Brokers place trades on behalf of their clients, usually retail investors or traders. Banks mostly act for other companies such as funds, however some banks are on their own behalf. Every day through there are a few important about bulls and bears, volatility and liquidity. Bulls versus bear. You often see between bulls. Bulls are market participants with a positive view of an asset. Bears are the opposite, believe an asset is overpriced. Right, okay. So, bulls versus bears is a battle. Bulls are market with a positive view of an asset, bears believing an asset is overpriced. When bulls outnumbers bears in the market, so when there's more people with a positive view of the asset, lots of people will be trying to buy, so the demand is high and may outstrip supply. This causes bull market, which with prices rising to new heights. On the other hand, when bears outnumber bulls, lots of people are trying to sell. This creates low demand and can increase supply, leading to bear market where prices move lower. What is volatile? Yeah, let's do this. So let's write this down. Financial markets can be represented as a battle between bulls and bears. So bulls are people with a positive outlook, thinking an asset will grow in price. Bears are the opposite, thinking it will decline in price. No, but believing assets overpriced, thinking the asset is overpriced. When bulls outnumber bears in the market, if bulls is bigger than bears, lots of people will buy. This increases demand and may be outstripping supply. If bears is more than bulls, lots of people will sell. Creates low demand. This creates low demand and increase supply, right? And can increase supply, creating a bear market with prices moving lower. Creating a bull market with prices rising to new heights. Creating a bear market with prices moving lower. What is volatility? Volatility is how much an asset's price will swing up and down over a period. Volatility is how much an asset's price will swing up and down over a period, right? Over a period. Bears and bulls rarely have total control over the market. Instead, its price will oscillate as one group, then another takes over. Look at almost any market's price chart and you'll see volatility in action. High volatile markets see significant moves which creates lots of profit opportunity but also increased risk. Traders with a high risk might look for volatility, while the more risk averse invest in markets basically less severe price movements. What is liquidity? Liquidity is how easily a financial market can be bought or sold. Liquidity is how easy a financial market could be bought or sold. If an asset has lots of potential buyers and sellers at any given time, then it's highly liquid, and you should be able to trade it easily without affecting its price too much. If a financial market has lots of buyers, right? Has lots of potential buyers and sellers. Potential buyers and sellers at any given time. There's lots of buyers and sellers at any given time. Then it is highly liquid. You should be able to trade it easily without doing very much. It could then be easily traded without affecting its price. If buyers and sellers on how you may struggle to find a suitable trade. Liquidity is an important factor in financial. Enables traders to move quickly and keeps prices competitive. Less liquid markets are generally perceived to be riskier than highly liquid ones. Right, okay, true. If there's few buyers and sellers, then it's harder to get trades going. Then it's harder to find suitable trades. Liquidity enables traders to move quicker and keep prices to move quicker and keep prices competitive. Liquidity and volatility in Forex. Watch our video to learn in the world's most traded market.
The Forex market is often said to be the most liquid financial market in the world. But what does this mean for you and your trading? Liquidity refers to how much money is flowing through the market at any one time, i.e., how many traders are trading and their total volume. The average daily turnover in the Forex market is $5.3 trillion compared to an average daily volume in the US stock market of $226 billion. Due to this sheer size, the Forex market can be extremely liquid. Euros to US dollars to Japanese yen, and British pounds to US dollars are the most commonly traded currency pairs and see the most volume. Liquidity in certain pairs can fluctuate throughout the day as markets across the globe open and close. Forex is tradable 24 hours a day during the week and is the most active in the world, meaning that prices can change quickly and drastically compared to other markets. This leads us to volatility. Volatility is the measure of how drastically a market's prices change. A highly volatile market will see its prices change more quickly and in larger increments, whereas a market with lower volatility will show prices that change more gradually over time. A market's liquidity has a big impact on how volatile that market's prices are. Although Forex is very liquid, the fact that currency rates are influenced by so many political, economic, and social events means there are many things that can quickly cause prices to become volatile. Volatility is often viewed as a negative in that it represents uncertainty and risk. However, higher volatility can often make Forex more attractive to day traders. Volatility can be your friend or your foe. It creates trading opportunities, but it also creates risk and uncertainty. Traders should be mindful of current events and keep up with financial news. This can help you better find potential profit and to better avoid potential loss. You can learn more about volatility and how to make the most of it on Forex.com.
I see. So, I think the news bit they mentioned at the end was really important, just so that, because they said that volatility is affected by lots of different factors, and then if you catch up on the news, you'll be able to like find out what these factors are and then better influence your decision. So yeah, UK Apple shares a new high of then rise again to within a week. Is this a bear market, bull market? Neither. UK Apple shares hits a new high. It's either a bull market or neither. I think it's bull market. Yeah, okay. When volatility high, is it a good idea to trade more than ever? Manage? I think it's both. Oh, I guess it's to manage the risk. Yeah. The currency markets see higher trading volumes than any other. Does this make them highly liquid? Cool. First lesson's done. What is Forex? The foreign exchange, also known as, is the world's most traded market. We've seen but just 4% in total volume. Forex trading is buying and selling global currencies. However, paper could something like whenever you buy a product and exchange cash for the holiday, you're trading Forex. However, the master of the art for practicals, speculative effort seek profit from it, and exchange rates speculating one will go down compared to the other. How Forex trading works. Forex is traded in pairs, meaning that when you trade Forex, you will always exchange one currency for another. When buying euro, for example, you're buying euros while selling the US dollar. Right, okay, so Forex is traded in pairs, as we know. Buying EUR USD. You're buying euros and selling the dollar. Selling the dollar. If the euro strengthens, if the euro strengthens, you need more US dollars to buy the euros, so the value is going to increase, isn't it? Yes. So your position if the euro weakens. So that means you would need less US dollars, so your position will decrease. Currency might never decline. For one currency to go, there will be others weakening against it. All currency cannot go up and say that there's always going to be a winner and loser. Ways where they can look something another, then trade that pair accordingly. Who trades currencies? Currency markets are crucial to broaden any company that buys, for example, needs. Central banks also be active as they seek to keep the currencies themselves under control. However, global FX trading is done by just 10 banks, who are responsible for around 2/3 of the world's volume. Only 10 banks, Jesus. The size of Forex makes it both highly liquid and dynamic. This high market liquidity means that price can change rapidly in response to news and short-term events, creating multiple trading each day. Banks trade Forex with each other 24 hours a day, attempting to take advantage of the other profit hedging against risk. The rise in leverage trading in recent decades has made more and more individual retail traders to enter the world of Forex. Whilst retail Forex traders might not be responsible for as much of the world as they actively tend identify when a currency might be in for a significant price move and trade accordingly. How is FX traded? One key difference between Forex and the market is shares and commodities. Shares is stocks, isn't it? And commodities is the things that are usable by like animals and industries and like oil, wheat, that sort of thing, isn't it? So, right? Commodities, physical assets. Yes. So yeah. It's how currencies are bought and sold. Instead of trading via central such as New York Stock or London Stock Exchange, foreign defined by interbank trading, the buying selling of currencies between banks constantly all over the world. When banks are dealing, this means that currency is open 24 hours a day. So this is the diagram they wrote. What is there for this? So I guess we're in London. London is 8 till 16. Yeah, that's kinda, yeah. Yeah, okay. Each currency quoted in pairs written in three letter code is example: US dollar, euro, Japanese yen, British pound, Canadian dollar, Australian dollar, Swiss franc. Why trade Forex? There are two key other reasons why it's the world's most popular market, going long or short. When investing in stocks, bonds or funds, you can traditionally only speculate on one price direction up. Forex trading is because you are buying one or selling the other, same, you can speculate on both upward and downward market moves. Volatility and liquidity. With so many trades happening each second, currency price is always on the move, which brings lots of opportunities for traders. It also means that there's lots of available buyers and sellers, which keeps supply high and tends to keep trading costs competitive. We'll go into short selling, volatility and liquidity in more detail in the trading basics course. Is Forex trading right for me? Forex trading is ideal for who want the opportunity to trade the market that's open 24 hours a day while minimizing trading costs, potentially following that markets are rising and falling. However, it contains significant risks to your money that is not suitable for everyone. Forex trading is ideal for people who are looking for short-term opportunities. FX traders typically hold positions for a few days or weeks rather than over the long term, want to make their own decisions. Most FX brokers provide an execution service. That means they do not advise you on what to trade and do not trade on your behalf, are looking to diversify the portfolio. Trading currencies can be a great way of getting global exposure. Test your knowledge. What is the currency code for the New Zealand dollar? That when buying GBP USD you are selling you're buying GBP while selling USD. Buying coconuts. HUF is a code for which currency? I don't really know. Okay, Hungarian forint. ZAR is a code for which currency? South Africa. Okay. Next lesson. Trading Forex. When you trade Forex, you are buying and selling currency pair. Yep. Such as EUR USD, GBP USD, or USD/JPY. Let's take a closer look at the anatomy of Forex pairs. The first currency in pair is known as a base currency. That bit there. The second is known as a quote currency. That bit there. Or sometimes as a counter currency. The price of a pair tells you how much of the quote you need to buy a single unit of the base. So this one, you could need 1.3010 US dollar to buy 1 euro. Say for example, the euro is a base, meaning, yep. Forex traders look to profit from fluctuations in exchange rates of currency pairs. So if you think the US dollar is going to strengthen against the Japanese yen, you might buy the URUSD to capitalize on the move. Oh wait, so if you think that US dollar is going to strengthen again, so that means, so that bit there means, so if you think the US, so if there's another USD against JPY. If USD, if USD is going to require more JPY, then you can buy more of this 1.3010 to get more US dollars, because then you would get more JPY, right? URUSD example. URUSD trader, you can buy 1,000 euros for 13,000. Yep. 1.31. You can now sell your 10,000 for. You can sell your 10,000 for 13, earning you $100 profit. Right. Okay. I see. Earning you $100 profit. Your position would be have $100 loss. I think that's a good image, that is. Jesus, why is that so... Oh my god, that's awful. Never mind not having that image then. Shorting Forex. But you don't only have to buy currency pairs. If you think that the base currency is going to fall against the quote currency, you can sell the pair instead. When you sell Forex, you're buying the quoted currency by selling the base currency. Yeah, because you're always buying or selling one currency. This gives you a position that earns a profit when your chosen pair falls in value, also known as short position. Short. It is one reason why trading Forex is so popular. There are no restriction or extra charges associated with going short. USD, GBP, USD short example. GB is trading at 1.3. You buy the quote by selling. So you sell that to get that. USD, GBP, you sell that to get the original 1,000 back, and you keep that as profit, because that is that. What is it? That is that minus that. Right. Okay. However, you would make a loss. Okay. Right. Okay. I see. So to summarize it then, basically, if you're using the base currency to purchase the quote currency, then you would hope that the overall what's this number called? The overall like number at the end. The overall number at the end is, I should call it the price. I guess the price is going to fall, because then you could get then you could use less of that the quote price to buy the original base currency. Yeah, but if you're You buy it for if you're buying the base currency, then you would want it to rise. Yeah, I don't know if that's even right, to be honest, but that's what I've gathered from that. So, what is a pip? A pip, that's the fourth digit one, isn't it? It's from what we learned, it's that one, isn't it? 1, 2, 3, 4. Point of movement in a Forex pair. So a pip is a single point of movement in a Forex pair. In most Forex pairs, a pip is equivalent to a single digit move in the fourth decimal point. Yep. So moves from that to that, it has moved 1 pip. It's a single point of movement in the fourth digit of a Forex pair. In the fourth decimal point, in the fourth digit after the decimal point of a Forex pair. It has moved up 1 pip because 7 plus 1 is 8. One important exception to this rule is the currency pairs of Japanese yen, and I quoted that. Here one in the second decimal point. If the USD JPY moves from that to that, has moved down 5 pips. Right, okay, so except where the Japanese yen is a quote price. Then it's the second digit, isn't it? And then it's the second digit. Down 5 pips. This is because the yen is worth comparatively little to other major currencies. Right. Fractional pips. You'll often see an extra fifth digit on the pip, after the pip, on a Forex quote. These are referred as fractional pips, or pipettes sometimes. They'll be written as superscript, smaller font size differentiate from pips. So, pipettes slash fractional pip is the fifth digit after this. Calculating the value of a pip. A pip is worth 0.0001. Pip. So there's 3 zeros, isn't it? Yeah. Of a single unit. 0.001. No, it's 0.1%. Of a single quote. That means you have to trade 10,000 units. That means you have to trade 10,000. Meaning 10,000 units of the base currency to earn 1 unit of the quote for each pip. Wait, so that means to trade 10,000 units of the base currency to earn 1 unit of the quote for each pip of movement. That means you have to trade 10,000 units of the base currency to earn 1 unit of the quote for each pip of movement. The amount of base currency you trade is known as your lot size. Right, so the amount of base currency being traded is known as the lot size. The amount of the base currency you trade is known as the lot size. You have to trade 10,000 units of the base currency because then that would be £10,000 to earn 1 unit of the quote for each pip of movement. What? To earn $1 for every pip that you earn. 10,000. Oh, because 10,000 times 1. Oh no, I mean, because that's 1 over 10,000? No. 1, 2, 3, 4. 1, 2, 3, 4. That's 1 over 10,000, isn't it? That number there. To earn $1 per every pip that you need, trade the equivalent of that. Remember that pip is worth that of the base current. See, when a quote is the yen, if you trade, you'd earn or lose. If USDJ, then that's equivalent to 0.01. What? That's bamboozling me. What the? USDJPY is trading at that. You use $10,000 to buy that because that is 10,000 times that to get that. Yep. Moves up, so you get an extra there. Can now sell that. So you made 10,000 yen profit. Yep, that makes sense. Your buy position earns you 100 for every pip of upward movement because it's 10,000 divided by 1. No, yes. Your buy position earns you earning you $100. No, 100 yen. What the? Oh, it's madness. Leverage, take advantage of the constant fluctuations Forex price. Leverage means you're only required to put a small amount of money known as a margin. Leverage allows the usage of a small amount known as a margin to control a much larger amount. So like a leverage is like a magnifying glass basically. It enables retail providers to prepare a short term for without looking away thousands of however mad ways so requires
Before you start Forex trading, it helps to understand how pricing works. Currencies are quoted in pairs. This is because you are trading one currency against another. Each currency is abbreviated into 3 letters. The currency on the left is the base currency, while the currency on the right is the counter or quote currency. When you look at a currency quote or deal ticket, you see 2 prices. On the left, there's the sell price or bid price, and on the right, the buy price or ask price. The buy price quotes the number of units of the counter currency on the right that is equivalent to 1 unit of the base currency on the left. In this case, 1 euro would buy 1.2956 US dollars. Because Forex prices move in such tiny increments, they are quoted in pips, typically the 4th decimal point of a price, equal to 1/10,000th. A pip is the smallest price change a given currency trade can make, so an increase or decrease in pips represents a profit or loss in your Forex trade. The superscript number at the end of each price is the fractional pip, which is 1/10th of a pip. This gives you even more detailed readings of prices and price movements. It's important to understand how to calculate the value of a pip. This will help you establish how much profit or loss you can make on a trade. The pip value is always determined by the counter currency. For example, when trading 10,000 euros to US dollars, each pip is worth 1 US dollar. This is determined by multiplying 10,000 US dollars by 0.0001, since 1/10,000th is a pip for all pairs, excluding Japanese yen pairs. So for each pip the price moves, you will make or lose $1. To streamline your trading, our platform automatically calculates pip values for you. So that's the pip. Now we'll cover the spread. In Forex trading, the difference between the buy and sell price is known as the spread. The spread is essentially the price you pay to make the trade. In this example of a euros to US dollars trade, you'll see the price on the left is the price you would get if you were selling euros to US dollars. The price on the right, what you could get if you were buying. The spread would be 0.00017, or because we measure Forex quotes in pips, it'd be 1.7 pips. The spread largely depends on the market liquidity and supply and demand. In a live trade situation, if you decided the euro was going to appreciate against the US dollar, you would buy at the price of 1.29565. Let's say you wanted to trade a mini lot, 10,000 units. This means you buy 10,000 euros. If you forecast correctly, the euro rises against the dollar. You can sell when it hits 1.30000 and you gain 43.50 US dollars, or 43.5 pips. But remember, if you forecast incorrectly and the euro falls against the dollar, you will lose money. You can learn more powerful Forex trading strategies and find more information about understanding pips and spreads at forex.com.
Right, okay, so ways to trade Forex. There are 2 main ways to trade Forex: spot Forex and CFDs. And CFD. Spot FX. This method of recovery, so trade the currency, trading the quote for the base works a little differently. FX. This. For the base. You're speculating on the price of movements. You're still speculating, but instead of buying selling quote, you're trading a contract that mirrors the price of the pair. CFD. Trade a contract that mirrors the price of the pair. What? Okay, we should cover that more trading with leverage course. Currency pairs. Currency pairs are traditionally divided into 3 groups later, primarily majors, minors, and exotics. Ooh. Majors are most active traded, currently at 85%. They typically cost less trade because they're so broad. Major pairs are currency pairs are divided into three groups: major, minor, and exotic. Majors are the most actively traded currencies. Majors are the most actively traded currencies. The major currency pairs all include the US dollar, Euro dollar, dollar yen, cable, Aussie, Swissy, Loonie, cable. While miners make up for the most of the market, you shouldn't ignore the miners. While major currencies make up most of them, you shouldn't ignore, also referred to as cross-currency pairs. These are all made up of the other combination of major markets. Spreads are often wider because of few people buying them. And Euro yen, Aussie Kiwi. Exotic currency pairs feature less popular currencies are traded less frequently in lower volumes. Due to these volumes, exotics are illiquid and can be more expensive to trade. Many view exotic pairs as having higher risk profiles compared to common trading. There's AUD, USD, CZK, GBP, and Euro. Australian dollar, Polish zloty, US dollar versus Czech koruna, British pound versus Danish krone, Euro versus Turkish lira. Good rule of thumb is if you need Forex is to focus one or two currency pairs. Generally, traders will choose to trade USD, USD JPR, GBP USD because there's so much information and resource available out about the underlying economies involved. What moves Forex markets? Lots of different factors can affect individual currency pairs price on any given day. Some common examples include economic data, central banks, politics. What makes news Forex market? It's about 40 minutes. I think we're going to end it here. We'll carry on with the what moves Forex markets in the next time. So, yeah, this is the end of the video. Thank you for watching. Goodbye. See you next time.